Yep, I mean, you're right, but at the same time, they blew themselves up. So it was not perfectly rational, even under the rules. You know, a lot of people who held equity in their own companies took risks that cost them personally. So rationality was not perfect. And I think a lot of people jumped on that and said, gee, we've discovered that rational actors are irrational. We cannot believe in the efficiency of markets because people aren't efficient. And that was held up as a revelation. My point in my Washington Post column was simply that we had known, because of behavioral economics, behavioral finance, right back to the 1980s, that people could be irrational, take too much risk, and so forth. So that's not the new thing one should fasten on. And in fact, the more important insights about the political constraints to regulation, and that's really what I think caused the problem.
Right. Their irrationality that blew them up was something they certainly didn't anticipate. Before I turn to Hal, let me ask you one more question. As I think back on this, I think specifically about the mortgage crisis, I think that the fact that banks were allowed to sell those mortgages so quickly and get them off their balance sheets was a main contributor to this whole thing. They didn't own the mortgage. They didn't have the risk anymore. They just got the origination fees and whatever fees they got. And that was one of the prime contributors. Mr. Mallaby, do you agree? Am I onto something or not?
I totally agree with that. And I would just add that the balkanization of the American regulatory system made it possible for risk and mortgage origination to switch around so that it was in whichever part of the system was going to be most lightly overseen. So, for example, you could regulate banks, and the Fed sort of tried to do that and say you should have capital and so forth. But then mortgage origination would move to non-banks. These mortgages would be packaged and sold to other folks who were not under the Fed's regulatory net. And so I think one lesson that was failed to be picked up after the crisis was that you needed to have more coordination and consolidation of regulation. And although we do have the FSOC, the Financial Stability Oversight Committee, I haven't met anyone inside the system who believes that's terribly effective. And so I fear that this system of multiple alphabet soup agencies allows financial actors to continue to game it.
So I think that was an interesting metaphor, Hal, that Sebastian had used, the balkanization of the financial system. And I guess you can look at it from two standpoints, the balkanization of the regulatory bodies and the balkanization of the financial system in and of itself. So you have multiple agencies regulating the financial system, different parts of the financial system, and maybe they don't overlap. So if you regulate, let's say, Estonia very, very rigorously, does that protect the rest of the Balkans from infection? And I'm thinking of the banks are in better shape than they have been in 10 years, maybe ever. And yet, have we really solved the problem here?
Yes, I mean, I would argue.
Hal.
Go ahead.
Thank you.
Yeah.
My concern is what happens if we have a crisis. We've taken many measures to make it less likely, as you pointed to. Banks have higher capital, we have more liquidity, et cetera. But the real problem is we're still going to have them despite what we try to do to resist them. And there we fall short, very short, because we've taken powers away from the agencies. The Fed's power to lend as a lender of last resort to non-banks has been very contracted. The FDIC's power to expand deposit insurance in a crisis has been taken away. The Treasury power to guarantee money market funds in a crisis has been taken away, and TARP is expired. So if we go back into a crisis, I hope we don't, but history says we will, the real problem is we have lost important weapons to fight the crisis if and when it occurs.
And what was the legislation that took all of those powers, those tools out of the toolkit? What was it?
Dodd-Frank.
Dodd-Frank did that. And
Yes.
Yet, would you say that the people who want to roll back and take out some of the regulatory efforts that were embedded in Dodd-Frank are misguided or doing the right thing?
No, I think what Dodd-Frank did arguably well was strengthen our ability to not have a crisis, sort of prevent a crisis. But again, I would say, look, we made the buildings more fire resistant, but that doesn't mean you abolish the fire department. And we took important steps to abolish the fire department. So Dodd-Frank's really a mixed bag. Ex ante, it did some good things. Ex post, it did some very bad things.